The boroughs are New York City. The burbs are everywhere else. Real estate is the ultimate game of risk and reward. It's the biggest investment most people ever make. Fortunes are made over a lifetime and lost in a day. And we're not playing with monopoly money. How do you stay ahead? Who's buying? Who's selling? And why? What do they know? We want the truth. You need an edge. Boroughs and Burbs is your secret weapon, giving you the insider knowledge and strategies you need to succeed in the high-stakes world of real estate. From Palm Beach to Palm Springs, Manhattan to Malibu, we press the experts to expose the pain, find the deals, and occasionally predict the future. That's Boroughs and Burbs, Thursdays, 3 o'clock Eastern, noon Pacific. Because everyone can make money in real estate.
Welcome, everybody. Welcome, Boroughs and Burbs, episode 148. Today's episode, 1031 Crowdfunding. I'm your host, John Engel from Douglas Elliman in Connecticut, and I'm joined by
Roberto Cabrera. I'm with Brown Harris Stevens, 26 years in Manhattan. Very excited to be here today for this.
Center of the universe, baby. Upper West Side. I love it. So thank you, partner, Roberto. Today we have two guests. We have Edward Fernandez of 1031 Crowdfunding, and we have tax expert Alan Blecher from CBIZ
Marks Paneth. CBIZ Marks Paneth.
And I'm going to share my screen and introduce you properly. There we go. Edward Fernandez, President and CEO. You can read his bio at 1031crowdfunding.com. There's some of the rest of the team. This is 135 years in real estate investments, and they've done $1.5 billion so far. And you can read all about the 1031 exchange marketplace. I'm going to tell you that I actually think I did some research on 1031 and typed it into Google and found this website, called that number. And so I am, I've gone through the experience quite independently.
Edward, it paid off. It paid off, Edward.
Yes, it did.
It did.
Yes, it did. Go marketing team.
So that's Alan, and you'll find him at the CBIZ.com, CBiz.com website. And there's Alan, managing director of CBIZ. We're going to ask him some of the tax implications of 1031 exchanges. And without any further ado, welcome, gentlemen. Welcome.
Thank you for having me.
Can we start with defining 1031 and then defining crowdfunding? Most of us think about crowdfunding as GoFundMe, right? Where I put an idea up on the internet and I hope that I can attract a whole lot of small investors or donors to my idea. Why don't you give me your more sophisticated definition of crowdfunding?
And you're talking to me, right?
Yeah.
Okay. So in 2012, there was a new law that came out called the Jobs Act, right? And prior to that, because I've been in the business for about 24 years now, prior to that, if I didn't know you, John, I couldn't offer you any type of product without having a pre-existing relationship. It was a huge no-no. So the Jobs Act came and said, hey, that's not fair. You've got these public companies, they don't need to know who investors are. So why do the private companies need to know? So the Jobs Act allowed us now to offer products, even if we didn't know you. So i.e. crowdfunding in the securities arena.
Okay. 2012 allowed it to happen.
Yes, sir. Absolutely.
And everybody piled in.
Oh, Lord Jesus, everybody piled in. Yes, sir.
But hang on, you said in my business. What is your business prior?
So my business is we create financial products in a structure, which is a security called a Delaware Statutory Trust, or DST, where an investor that's either tired of dealing with the tenants, toilets, and the trash, don't want to do it anymore, or, 1031 exchanges, you have 45 days to find something, and sometimes they just can't find it. So they come to our website. So we have apartments, senior housing, student housing, self-storage, etc. on our website, where an investor can own a fractional interest of this property, depreciate the asset, write off their expenses, get monthly cash flow. When we sell it, they get 100% of the upside while still satisfying their exchange without the headaches of actively managing real estate. So that's what we do.
So it's a backstop.
It is. It's a backstop if you're a younger investor that wants control still, or it's your primary if you're 60, 65, your kids don't want to take over the business, you definitely don't want to pay the taxes, but you want to defer, i.e. 1031, they come to us.
So typically a 1031 is you got to find a like-kind exchange. So that principle is kind of dissolved in this scenario.
Correct, because, you know, and Alan can speak to this, but like-kind is just real estate to real estate in this case.
In my case, I had a client who was 80 years plus, no kids, and had a great big portfolio of real estate. And we had an offer on his, say, $2 million house, second house out here in Connecticut. And he said, but I've owned that for decades, right? You probably encounter this a lot. I'm going to have an enormous capital gains on that house that I only paid less than $1 million for. Now I'm going to sell it for $2 million. And I said, well, you know that we could put this into a 1031. And he was like, I know, I've had difficulty identifying one. I think the rule is that you have to put in more than $2 million into the next property. You can't trade down. Is that correct?
Right.
Alan, you want to take that?
Yeah. Okay. Sure. Well, basically the situation with the 1031 is, and at this point, after the Tax Act of 2017, you can only do a like-kind exchange with real estate. Prior to that, you could do it with other types of property, but it had to be property held for use in a trade or business or quote unquote for investment. So it couldn't just be a quote unquote personal asset. It had to be used in a trade or business or held for investment. In the real estate world, that basically means you have a commercial or a rental building that you're owning and operating. Now, what happens is it's a like-kind exchange. Theoretically, could be I have a building, you have a building, we meet in your office and we trade them. That very seldom happens in practice, although that's a direct exchange. Usually what happens is, in probably your client situation, is you can sell your property that you're trading, for lack of exchanging, it's a more technical term. And I don't want to get too much in the weeds on the requirements, but basically you can't get the cash. The cash has to go into what's called a qualified intermediary, which is someone that takes your cash and buys your replacement property. And if it's done within certain timeframes, when it's treated for tax purposes, as if you had traded your property for the property that's bought. But you have to trade at least even in value and equity. And value is how much you sold it for, and equity is how much you sold it for less the debt that was on the property at that time. So you can't trade down, but you could trade laterally or up. And it's which is mentioned so far, two of the biggest sort of not even footfalls, you have from the time you sell, you have 45 days to identify the property or certain properties you can pick from a designated group that you're going to exchange into. And that 45 days is not a long time, unless you have decided to do this months ago and you've already done some of the legwork. 45 days is not a long time. And then you have a total of 180 days, which includes the 45 days to close. And as things can happen, stuff happens. In this world, that's not an incredible amount of time. But that in a nutshell is basically a 1031 exchange. What it does, and the beauty of it, as you were mentioning, is the gain that you otherwise would have recognized if you had just sold this money and walked away is deferred. Now, this is something that's very important that a lot of people hear it, but they hear it, but they don't hear it. The gain isn't eliminated, it's deferred. And, again, without getting too code speak, the basis in the property you sold essentially carries over into the new property that you acquire. And at such time as you sell that replacement property, that's when the gain is recognized. Sometimes people think it's eliminated, it's deferred until one of two things happen. You either, if you sell it, the replacement property, it's recognized at that time. And then the other possibility is if you die holding it under the basis step-up rules, there's at least this curling effect, that gain could go away. But basically, there's no saying death and taxes are inevitable. As I always say, there's two things. In the real world, in the business sense, a loss is bad. In the tax world, a loss is good in the sense that you pay less tax. For most purposes, I think we could all agree dying is bad. Dying can be good in the tax world. For instance, if you've got a 1031 property, that gain would be eliminated because of the basis step up at death. But basically, the 1031 is a mechanism to defer the gain you otherwise would recognize by essentially trading your real estate for another person's real estate.
So tell us, if the basic, aside from death and the step up, what is the reason why someone, if the basis isn't going to change, why would they exchange property?
Well, the big reason is they want to frankly, it's put off to another day. I mean, why just, when you're little, your mother probably said, don't put off tomorrow what you can do today. When it comes to paying tax, it's a deferral. And what some people plan on doing, they have like serial 1031s. Most people are of the view that if I can put this off, I'll put it off. I don't want to deal with it now.
But from a standpoint of value, just so everybody can understand, you have building A that you've had for 20 years, and it's got an X basis on it. You're going to exchange that for a different property. You're deferring. But what's the point?
I may want to defer it forever. Let's say the example I used.
But why not just keep the property you have?
Well, because if I have a killer offer on that $2 million house and my basis is $1 million, and I don't want to write a check on the $1 million gain, then I'm going to park it with Edward Fernandez's 1031 crowdfunding. I'm going to park it until I find another opportunity that I want to get involved in. Is that right?
Well, I think Roberto, to answer your question, reality is, think about this. Let's say you had a $2 million property and you're getting, most of the time, investors don't even know what their cash on cash return is. They might be getting 3%, 3.5%, right? On the current basis that they bought the property on. But if the property doubles in equity, it makes sense to liquidate, capture that equity, reinvest that equity into another property. Now your cash on cash return on equity might be higher, right? So an exchanger that is, and we call it swap until you drop. That's what we call it. You're going to swap until you drop, right? An exchanger is really not in the business of capturing the equity for themselves. They're in the business of building wealth for their generation, and they get the benefit of the cash flow while this event is waiting to happen.
Right. Not that I don't understand that. I wanted you to explain it because I can't explain it as well as you just.
You know what? Here's how I do it. Here's how I do it. So, Alan, I appreciate that, but man, a client to listen to that would like shoot me in the head. So here's how I explain it. I explain it 1031 exchanges being on a surfboard on the North Shore of Oahu. Waves get like 50, 60, 70 feet high. So as long as you stay on that surfboard and you ride that wave all the way to the shore, i.e. you die, no matter how big that wave gets, it never comes crashing down on you. But until you decide to get off that surfboard, when you get off that surfboard, that wave could have started at 20 feet. Now it's 50 feet. All those taxes come crashing down on you. That's how I explain it.
Talk to me about the growth of the industry since 2012. So they passed this rule. Was there a pent up demand and people finally said, finally, I can take advantage of 1031 rules?
It's huge. In my space, when I went into this business, the amount of equity that was going into these type of products was only like $300 million nationwide. In the peak of 1031 exchanges with the low interest rate environment, the highest amount of equity that was going into these deals ended up being 12 billion in equity on an annual basis. And so, and it's really tied to the baby boomer generation, right? The baby boomer generation is getting older and older and older. They have all these assets. They're too old to manage these assets. Their kids want nothing to do with it. Their basis is so low. Their depreciation recaptures through the roof. The best thing to do is actually exchange with us.
Can you give me an example? Because for a lot of the people who watch this show are thinking about houses, right? And I just gave you the example of the $2 million house with the $1 million basis. But that's not the only kind of product you're looking at. You just talked to me about cash on cash returns. So I might be able to sell my beach house, my $2 million beach house, put it into the 1031 crowd exchange, and you might put it into a McDonald's somewhere else in the country that's paying me a monthly return. Is that more typical?
Yeah, pretty much. It's the way we work is our clients, because, you know, I'm in the securities industry, right? So I have a fiduciary duty to my clients. And so what we do is we diversify. The unique thing is that the minimums are as small as $25,000. And so basically, if you have $1 million of equity, you can literally buy some apartments. I can do some student housing, senior housing, self-storage, industrial. I literally create a mutual fund type effect while utilizing a 1031 exchange that allows me to mitigate putting all my eggs in one basket.
Oh, so it's unlikely that I'm going to go buy $1 million of a McDonald's. You're going to spread it 5 different ways, 10 different ways?
It depends on the client's willingness to do their taxes. So if they have somebody doing their taxes, fine. But you got to remember, if wherever you own a piece of real estate, you may not have to pay taxes, but you're going to file. So if you diversify yourself with 20 properties in 12 different states, that's brain damage, right? They don't want to do that. So diversity is based on how much headaches you want in dealing with people like Alan.
So
well, if I could just kind of first say, a lot of times when people say things like that, my answer is that, you know, in this day and age, let's just use your example. If I have a client that's going to file in 12 different states because it goes into one of your products, that's a huge pain in the neck for me to get all that stuff done. And under the, you know, back in the old days, you'd send a client, you know, a phone book of 12 tax returns, and you'd have to mail them and blah, 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 blah. Now, my answer to that is, even in the old mailing in the returns days, if you're really killing it with your returns and it's a great investment, so you have to go to the post office one day a year with a stack of papers. That you know, now under the way it's been for, I don't know, at least 10 years, if not more, with electronic filing, it boils down to a client may have to sign 12 separate electronic filing authorizations and scan it back to me. The burden is way more on guys like me to have to sit here and prepare 12 returns versus one. The burden's on, you know, I mean, I have clients a lot who end up not necessarily in the DST, but for various reasons, their tax returns have to go on extension because they've invested in things where they get a K1. And they say, I've had clients say to me, I was thinking of going into XYZ fund, but you know what? I'm not going to have the information until September. I want to file in April. And I think to myself, that's my problem.
Yeah.
Why would you forego a good investment because of that? But
I agree. But, you know, clients are like, well, Ed, I'm going to earn a 6% return on my equity, and I'm going to give Alan 3%. I'm not doing that. Right?
So it's essentially a fund, and you are deciding what you're going to invest in, and you can invest cross state. And where are you located, Edward?
We're talking from Orange County, California, and we have another office in South Lake, Texas, out of Dallas, Fort Worth.
Okay, but you invest, you take the money, that's in the fund and you invest in whatever you want designated, for example, like it's high risk, it's whatever. I mean, are there different designations of?
No, so in these trusts, so think of the Delaware statutory trust as a living or family trust. There's a trustee managing a trust for the beneficiaries. So investors are beneficial owners of a trust. It's as simple as that. But the DST has to have stabilized assets. You can't have value add opportunistic type deals in a DST. You can't even move walls. You can change cabinets and carpets and appliances. That's the amount of, of touch up you can do. But the DST has to have a stabilized asset, and 9 out of 10 times it's producing current cash flow. You can't go into the value add or opportunistic type areas.
But who's choosing those properties?
So we are choosing these properties. So for us, right? So I'm a sponsor, syndicator. We create our own DSTs. We've been doing senior housing for 18 years. So my entire staff understands that product mix. But then we also distribute third-party products from syndicators like me that are experts in their asset type. So what we do, because we've got the infrastructure to do due diligence on all these asset types, because senior housing, it's not like buying an apartment building. It's kind of like running a hotel. It's not easy, right? So because we have that expertise, we can do the due diligence, whether it's our deal or third-party deals, prior to selecting a product to the investor.
The crowdfunding part is a little bit confusing to me. If, let's say, using this example, I've sold my asset and I've given you my $1 million, and for simplicity's sake, you decide that you're going to diversify me into a self-storage unit, a KFC, a 7-Eleven, and, as you said, senior housing. So, you've put me into 4 assets. Is it possible that each one of those assets I'm going to stay in for a specific term, 5 years for the first 2 and 10 years for the next 2, and that I own a share, basically in this case, a $250,000 share in the nursing home? Did I get that right?
You're tracking, yeah. So the thing is that if a DST has 7 deadly sins, one of those sins is you cannot refinance an asset. So if a DST has debt on it, because most exchanges need debt replacement, right? The DST cannot refinance. So normally debt terms are 10-year terms, 25, 30-year AM schedules. And so the DST has this freight train coming at it by year 10. So by year 10, you need to be able to make sure that that asset has appreciated to a point to where you would liquidate it and it's accretive to the investor. You don't want to put a predetermined date inside your offering memorandums, because if I said, hey, I'm going to sell this property December 31st of 2024, and we're in the worst recession ever, I'm forced to sell it and the clients get dinged for it. And so time holds time, or time to hold the asset normally is about 3 to 6 years. And then the DST recycles the cash. They actually send the money back to the qualified intermediary, and the client's in the position to do another exchange. They can do us, they can do something on their own, or they can decide to pay the tax, but we can never just roll cash into another deal. We got to send it back to the client first.
So what you're saying is that when you're selling the asset is independent of of my schedule.
Correct. Because the trustee controls it. Here's why, and let me tell you why, and Alan probably knows this very well. In the Great Recession, the primary passive way of doing exchanges is through what's called a tenant in common, or a TIC, okay? Very similar, where you had fractional interest in a piece of real estate. The problem is that the TIC, all the investors controlled everything. If I needed to change the roof and I needed to change management, I needed to refinance the asset, you needed to have 100% unanimous consent. And everyone agrees when real estate goes up, right? 2006, 7, 8, 2007, we were good. All of a sudden, October 2008, things weren't so good. Property values dropped by 50%. And guess what? that was like herding cats. You have savvy people, not so savvy people, but you needed 100% consent to do anything. So about $6.5 billion of TIC interest went into receivership. So they did away with that and said, okay, we're not doing that anymore. So the trustee who has real estate expertise that the bank trusts is control of the decision-making of when the asset is sold.
So if I've got money into this basket of assets with different maturity dates, I've identified different maturity dates to you. Let's say we have a downturn and you're saying, well, I'm not selling the asset right now. It's not a good time. But let's say I want to call capital. I say, but I need some cash. Is there any way for me to get out of some of those investments?
Yeah, no, that's a great question. So we have a secondary market on our website. We currently have about 80,000 registered accredited investors. So we've created our own little secondary market already. So in the event you say, hey, Ed, I need to get some cash out. I want that DST. So what we would do is we would put that DST on the secondary market. I would strongly suggest the client take a discount, because once the discount is hit, the cash flow immediately goes up. And that's going to incentivize somebody to take that position. So we'll
wait. Slow down on that. What does that mean? Who's taking a discount?
So here's what it is. Okay, so you need money. It's an emergency. Okay, you have 3 ways of doing it. Oh, I want a premium. Get me out at par, or I'll take a discount. I'm emailing 80,000 investors to say, hey, this deal's on the secondary market.
And in this case, I've got senior housing as a quarter of my portfolio. And I say, I'm willing to take a discount, get me out of my senior housing position, put it out there on the secondary market. I'm willing to take a 10% haircut.
So that let's say the senior housing deal was paying a 6% originally. A 10% discount may get it to a 6.6%. Because you got to remember, the secondary market only may have 3, 4, or 5 opportunities. The primary market on my website has 60 opportunities. So you got to weigh the 60 opportunities compared to the secondary market. If the 60 opportunities is paying a 6 and you're not taking a discount and your deal pays a 6, well, why am I going to do your deal? I needed to look at a 6.6 compared to a 6 from the entire other market. Oh, I want that secondary market deal because I'm getting a higher cash flow.
At what point does Alan wave his finger at me and say, wait a minute, the tax implication of you needing money, is going to bite you?
Well, that's the thing, right? So
Alan,
if there's the money, they're getting dinged on the tax
point. That's going to be at that point. I mean, once you're selling, that's, this gets back to what was being said before. You essentially, in the DST structure, you own a proportionate share of everything that's in there. And if you're selling a piece of it, it's as if you're selling your share of the senior housing in that example. So I would certainly like to know about this ahead of time, because if you're just planning on cashing out, that's going to come back to bite you.
Can I offset that? I'm going to pay the tax. Can I offset that loss with something else, or no? Meaning I exchange, I had that $1 million of gain. Right. I only have 4 positions with Edward. I'm selling one of them. So basically I got a $250,000 gain. And even though I'm selling that piece at a discount, I've got a gain.
Well, yeah, right. Well, you could offset that with a loss you've got somewhere else in your portfolio, let's just say. That you could do, sure.
Oh, I can. Okay.
Yeah.
Is it, I'm just trying to dumb this down a little bit for myself, Is this not just a REIT with a different designation, like as if it's an IRA of some sort, like in the sense such for tax purposes?
No. So a REIT doesn't own real estate. Okay. It owns an operating partnership that owns real estate. So when you buy REIT shares, you're buying shares of a company. You're not buying real estate. And that's what most people don't understand. So if I had to build a mental org chart, top box REIT, box underneath that, operating partnership, and then horizontally, boxes under that is SPEs or special purpose entities. That's where all the real estate is owned, right? So in order not to get taxed in getting involved in a REIT, you have to own operating partnership units, and that is called a 721 exchange or UPREIT. Whole different ball game.
Yeah, that's a whole separate animal than a. I could maybe.
That's a whole other show.
That's a whole other show, man.
I don't. One thing, I did. If I could just jump in here for a second, probably not as colorfully as Edward just explained it, but you hear a lot of things on the radio, commercials and stuff about 721 transactions. In a 721 transaction, what would happen is you would take your building and contribute it to a partnership, which is called the OP. It's operating partnership, and under the partnership tax rules, that is also a deferred gain. So I don't even think of it as like a 1031, but in the sense that there's a gain deferral, it is. In other words, you have a building worth $1 million, you have a basis of zero. You contribute it to an OP, you don't recognize $1 million gain. But the way these things work is that when eventually, at some point, you're going to convert your OP units into shares in the REIT, and at that point, it becomes taxable. And then you own stock in a REIT, which is a corporation, a special type of corporation that owns an interest in a partnership that holds real estate.
But then if you die, right, Alan, if you die and do not convert your OP units to REIT shares, you still get the step up in basis. Right. And now your heirs get that tax-free money, then they can convert into REIT shares and liquidate tax-free.
Yes. Like I said before, unfortunately, in the tax world, sometimes it pays to die. I hate to say that, use that phrase, but
swap until you drop, baby. Swap.
Well, that's sort of again, it's sort of the question before about what if I find out any money in the interim. That the whole linchpin of this that's a great way to look at it. Swapping till you drop, and if you're not going to wait till you drop, there's going to be a tax bite.
Yes, sir.
Walk me through the small-time investor who wants to try this, dip the toe in the water. You talked about $25,000 minimum, but let's say I've got my portfolio, I've got my stocks, and I think the stock market is overheated, and I want to try real estate. I don't have an exchange, but I can go into your market or your secondary market, and I can buy shares. Talk to me about what the small investor, how he gets into this.
Even a cash investor can invest in a Delaware statutory trust. The way that it's defined as being an exchange is how the money is received. If the money is received from a qualified intermediary, it's considered a 1031 exchange. If you write a check from your brokerage account, you're a cash investor investing in the same vehicle. Now, the end result will be when that property goes full cycle, you now have the option to do an exchange if you choose to and defer taxes from those gains because you already used post-tax dollars to invest in this in the beginning.
I sell my Apple shares. I've got to pay the tax on the gain on the Apple shares, but I can put it into real estate in order to get diversification. And you're saying I don't have to pay again.
After it goes full cycle. Now, there's another product called an opportunity zone fund, which is also a whole other show, which defers gains on personal property as well as stocks and bonds and things like that. You can invest in opportunity zones and get those deferrals as well.
Is that what this qualified opportunity fund is that's mentioned on your?
That's exactly right. That's exactly right.
That's the qualified opportunity funds is a creature of the 2017 Tax Act. And, again, that's another show all by itself. But the one advantage to it, there's two advantages to it, quote unquote. The first is that you don't have to be exchanging real estate. You can sell a personal, an old watch you have or something like that, or a stock they always give the example of, you wake up one day, you find the stock certificate behind your dresser and you sell it for a huge gain. You can invest in an opportunity fund. You do it to have a gain. To take advantage of the QF rules, you do have to have a gain. But assuming certain requirements are met, which are way beyond this discussion, the big home run in an opportunity fund is if you hold it for more than 10 years, all the appreciation from your investment in the fund until the exit after 10 years does escape tax. That is, for federal purposes, states may differ. That is an elimination. You don't even have to die to get that benefit.
And you only have to invest the gain. You can keep your basis in your pocket tax-free, where in an exchange, it's called, you have to spend 100% of your equity and meet your equal or greater value.
Yes.
In an op zone fund, you only have to invest the gain. You can keep the basis and put it in your tax with no tax liability.
Can I ask a question? Dovetailing into John's original question about the small investor. Who are these 80,000 people, or who are these investors or people that are part of this exchange? Are there a lot of multi-billionaires? Is it a big variety of people? Who's involved?
These are all accredited investors, right? Defined as an individual, $250,000 in income, or $300,000 per couple, or $1 million net worth excluding their home. And so these investors, through my PR team, come to my website, right? They register to our website and they're looking for real estate investments. Either they have an exchange, or they're investing in our bridge fund or our note program. They just want exposure to the real estate market, but 9 out of 10 times they're in an exchange situation.
But are these people looking for tax shelters and things like that? Are there billionaires doing this all day long?
Oh, billionaires, of course. How do you think you become wealthy when you don't? How do kids from generation to generation become wealthy if you never pay the tax? You just got to die. I died. My great grandfather died. My great father died, and I get all that gain, all that wealth. So that's how you build wealth, is by deferring these taxes until you die.
I guess what I hear Meredith asking is, if I'm a billionaire, I buy the whole property. Is this a particular opportunity for the small investor for whom buying the entire property doesn't make sense, either from a diversification point of view or a length of time point of view? This is a way for the smaller, hence the crowdfunding part, a smaller investor to participate for the first time.
Yes. So because it's institutional quality real estate, most investors would not be able to buy these properties on their own. They're anywhere from $25 million to $300 million properties. And so an individual investor that's used to buying single family residences can actually invest and own an institutional type property that they wouldn't be able to buy on their own unless they were a billionaire.
And the downside, I mean, if I'm a billionaire, I can buy the whole thing and I can sell it at my convenience, whenever it makes sense for my portfolio and for the asset. But the downside for the small investor is I've bought into the senior housing complex, and my timeline might not align with somebody else's timeline. So I've got to, if I want to get out of it, I have to sell on the secondary market. If I want to get out early, I have to sell on the secondary market.
Correct. Here's the downside: control. You do not have control. If you're a control freak, this is not for you. Okay. That's the bottom line. We get investors that are 40, 45 years old. They're control freaks. And I tell them, look, this ain't for you. We ain't going to sell it. You ain't getting out when you want to get out. Just keep doing what you're doing. They're on day 43. Oh, Ed, no way. I don't want to pay the taxes. My taxes is like half of what I just earned. I'm going to do your deal. So they use it as a parking lot, right? They park the car, throw away the keys for 3 or 4 or 5 years. They come, take the cover off the car, blow off all the dust. When the exchange is done and the property goes full cycle, and they start that car up and drive into another 1031 exchange.
Yeah. Well, no, that's a very important point because a lot of people, they hear these things, and you really do have a relatively short window. And if 45 days to identify, you don't necessarily have to identify the one property you're going to acquire, but there are certain limits on how much you can identify, and 180 days to close from the beginning, not 100 days after the 45. That is a relatively tight time frame. And if you're not someone, I just had a conversation weeks ago with someone who was like, they were weighing a DST against other types of investments. And they said, well, if I don't do this DST, how am I going to fly over the country and do my due diligence? Well, that's the answer. If you're a professional real estate person, this is what you do every day. You're gonna get on a plane and look at all these different properties and whatnot. If you're not, or sometimes what happens is you have people who were control freaks at one point. I'm sure you've had this situation, and now they're getting a little on in years, and they say, screw it, I have this, I want to have the benefits of a 1031. I can't be involved with having people call me in the middle of the night because the toilet's broken.
Yep,
I'll put it
all the time.
They might have been control freaks 25, 30 years ago.
Yep.
They're not control freaks anymore.
Nope.
So, Edward, can I ask you about your business? Is this a very niche part of the business of which you're one of few doing this, or is this extraordinarily widespread throughout the country and you can find this, these opportunities everywhere?
There are 54 companies that do, I would say 54 sponsors that create these products in our industry, but there are hundreds or even thousands of brokers in the financial services industry that distribute the same products. So if you go to like JLL has their own DST, right? And JLL is in the wirehouses, the Merrill Lynch's, the Wells Fargo's of the world. So you've got big, giant companies that are in the real. Cantor Fitzgerald has their own DSTs. So it's become very mainframe and very popular, even with the large real estate firms that have been doing real estate for many, many years.
So you differentiate yourself by the properties that you're buying, et cetera.
I differentiate myself because I buy my own real estate. I write checks for 30, 40, $50 million. If I'm putting that kind of cash up, you best believe I'm doing my due diligence, because I don't know if anyone on the show is going to invest in my deal. I might have to keep it, right? So I'm going to do my own due diligence. So that's the difference between me and brokers. Brokers are just selling a product that their financial institution has approved. That's not me. I've approved it because I put my money up. So I've got my own skin in the game. So you best believe I'm not losing my money. So that's how I separate myself from those other guys.
What kind of return have people been seeing, and how is it even measured? It occurs to me that I've now put my $1 million, into this basket. And when you said, well, I bought you into the senior housing, and we put you into some retail, and we put you into some self-storage, and you can expect a cash on cash return of, say, I don't know, pick a number, 6%. But there could be an appreciation of the asset at the end of the life, which cannot yet be determined. So talk to me, is 6% realistic? Or are we seeing higher returns, lower?
6% is realistic when it comes to actual physical real estate. Now, if you talk about minerals, oil, natural gas, natural liquids, which is also qualifies for an exchange because you're buying the dirt has the minerals in it. And when the minerals come out of the ground, the commodity strike price determines the cash flow, right? That could be 8, 9, 12, 15, depending on the price of oil. That qualifies for an exchange. But when we're talking about physical real estate, from 2012 to 2021, people were seeing 3x on their money. You put $100,000 in, you got $300,000. That is not even including your cash flow. So they were smashing it, right? Just like a normal real estate transaction. In today's market, I'm okay saying, maybe you're going to see a total return inclusive of your cash flow, maybe between an 8 to 12% annually. That's cash flow based on appreciation, just because of where interest rates are today.
Is that a theoretical, or can you put me into some lithium mines?
I don't know about lithium mines. I don't like those poor kids digging holes, you know. So that's a whole other conversation.
Can you get me into rare earth minerals?
Here in California, we love our electric cars, but we don't know where that lithium comes from.
So, Edward, what are the newest types of properties that you're looking at? What you weren't looking at 3 or 4 years ago that you're looking at now?
That's a great question. So we're just closing on 2 properties today, right? And we've bought these properties from Fannie. So prior to the interest rates environment, buying stabilized assets was you can buy stabilized assets maybe in the senior housing space on between an 8 to 9 cap rate, right? That was all day long. Now that's hard to do because everyone's chasing that asset type. But the problem is that you've got about $4 trillion of loans coming due in 2025 and 2026. And these properties, terms on the debt are coming to an end, and you can't refinance from a 4% into a 7%. Absolutely impossible. And you're not going to throw good money into a bad deal. So Fannie is starting to take properties back. So I'll give you an example. Small deal, no big deal, but we bought it for 3.7. It appraised for 6. I put an operator in it. I get it to 90% occupancy. I'm selling it for 15, right? So that's where the gig is, right? So there's this book called Who Moved the Cheese? You guys got to read it, right? It's 2 little mice, right? They're sitting there in this little wall, and the cheese keeps calling from the sky, right? And so all of a sudden the cheese stopped coming. And one little mouse said, hey, I'm going to go find this cheese. And the other guy said, I'm staying waiting here. Well, the guy that waited died, and the other one lived because the cheese moved. You cannot focus on stable assets today. The cheese has moved. You've got to focus on value add and opportunistic. This is not where you become rich. This is where you become wealthy. And that's our strategy moving forward until interest rates change.
And when you sell that rent stabilized for $15 million, you are by law have to return the money to me, right? That's done with that asset. But then Alan, says, aha, you got to reinvest it. And so I turn to you and say, what else you got? And you're like, well, I've got 3 or 4 more we're looking at, and we'll meet the 180-day requirement. Don't worry about it, John. I got you.
Yes, sir. That's exactly right. Because look, as you're a client, if I make you money and I do what I told you I was going to do, you're going to tell me, Ed, let's roll it again. Right. And I'm just going to roll it and buy another one and buy another one and buy another one. And that's why, we have over 1,500 clients, and they continue to invest over and over and over again because we do what we tell them we're going to do. Now, we're not perfect and can't guarantee anything. We don't have a crystal ball. But, we have the infrastructure. No, I wish I did. I'd be playing the lotto. I'd be in Monaco watching F1, not on this podcast, right? So that's absolutely right, John. We would actually roll it into another deal with your permission.
Pete, Scott, you got any questions? Are you convinced? Has Edward Fernandez convinced you that you need to be trying this with part of your massive portfolio?
Well, I wish I had the massive portfolio. Oh, sorry.
Well, it looks like behind your screen there, it looks like you have more than a massive portfolio.
Well, this is when I get to camp out at my clients' houses as opposed to my own. So we have lots of good photography for the backdrops. No, I mean, I think that having invested somewhat in commercial real estate, I mean, there's no question that doing 1031s individually, you have to be a very active investor. And so having somebody else actually take care of this and handle the issues and not get to these points of, oh my God, I got to do a deal, in 2 weeks and the guy's on vacation or a lawyer's out or we have some, really weird point. there's a lot of benefit to it. And so I get it. And I think it's a great idea. And I think that having professionals manage your money in something complicated is a very good idea.
You'd have done 1031 exchanges. You sold a commercial building and you were up against the timeline of trying to get into another building.
We actually did a reverse 1031.
Oh my God.
Yeah, so that raised the level of difficulty there.
Yeah.
Oh, that's good stuff.
Let's
right
describe that situation. What was the situation?
We bought a building before we sold the other building. And so that meant, and I believe you get 6 months under that terms to sell what you have to apply it toward the other building. And I think we closed on our sale at 6 months minus 3 hours, something like that.
Yeah.
So
one thing that's very onerous about these requirements is these the 45 days, they are etched in stone. Just as an example, if April 15th comes on a Saturday or a Sunday, you have till Monday to file your tax return. If your 45th day is a Saturday or a Sunday, that becomes Friday. Same thing with the 180 days. There will occasionally, I mean, I think under, during COVID, they gave you some relief. Yeah. But if you get sick, I mean, you're in 180 days and midway through, all of a sudden, God forbid, you have an illness. Sorry, they're immovable. So you do, these are relatively tight time frames for the uninitiated. Even for the initiated, they're fairly tight. And you really have to, you really have to think. This is something, and again, once you can't decide to do this after you sold you have to do this up front, because let's talk about a forward exchange, because reverse exchange is just way too complicated. But you can't sell a property on Monday and on Wednesday decide, oh, maybe I'll do a 1031. The moment that cash hits your hand, you're done. Yeah. You have to set it up so it goes right into what they call the qualified intermediary, and then they do all of their stuff where they're holding your money. A forward exchange is essentially like, if you think of it as a trade, but the property you're getting in the trade comes to you before you give the other guy, looking at it from that standpoint. It's a forward exchange in reverse, but it is, you don't see them as often, and they're kind of like knuckleballs when you have to deal with them, because when you're used to getting a fastball and you get this like volley floater coming at you, sometimes it's like the world on its head.
I was reading a research piece from IPX 1031, who's owned by Fidelity National. They own Chicago Title. They do about 15 billion in exchanges a year.
They're out there.
They're out there, and they did this research piece, and they were saying that 66% of exchanges fail because of not being prepared.
Oh yeah.
On that 45-day ID period, because it's 45 calendar days, not business days. Christmas, Thanksgiving, your birthday, weekends, it all counts. And if you're not thinking, look, don't sell your property without getting a real estate broker in your offering documents. When you're signing your purchase and sale agreement, put a contingency in there and say, I am not closing on my property until I find a replacement property and I have it under contract. If you don't do that, you're at risk of paying the tax. Or call Ed Fernandez. We'll save
exactly. Calling Ed.
Call Ed. We'll save the day.
Yeah. Years ago, I had a client that was the U.S. subsidiary of an offshore company, and they were big. They were a big company, but in a foreign country. And the people I was dealing with, they spoke English very well, but the Internal Revenue Code and tax law is not even English. And I said to them until I was blue in the face, I stressed the importance of the qualified intermediary. And I said, do you people have one? We can refer you to one. I said it, and when my colleague said, you're talking to them like they're 5 years old. I said, I know, because this is very important, and they have to hear what I'm saying. And they and sure enough, one day I get an email from my colleague, mentioning how, oh, here's a closing statement. Now, what he didn't tell me was they decided not to do a 1031 after all. So he says to me, oh, FYI, here's a closing. I see the cash went into their pockets. I had an embolism. I sent them this email. Are you kidding me? You know, and I can't believe it. And then he said, oh, I forgot to tell you, they decided not to do it. I said, okay, well, now I can breathe a little easier, but, you know, and he, you know, and it's not a lot of time. 45 days. You know, that's one of the biggest. Another thing that does happen occasionally is people, they meet the first piece of 45, and then somewhere in the next 135 days, for whatever reason, I don't know, they get gun shy or something. You do see that occasionally. You know, I get calls all the time, not all the time, occasionally. You know, we had this client, they were going to do a 1031, but it failed. And I said, what do you mean it failed? And it is more often, just as often, you'll hear 150 days in, they just said, screw it. They couldn't find anything to their liking, whatever. It does happen occasionally.
When the money went into his pocket, he was done.
Done.
Oh, yeah. The moment you that's it. That's like
there's another term called constructive receipt of proceeds, right? Oh, Ed, no, the money didn't go in my bank account, but I picked up a check. You're done.
Yeah. No.
It's constructive receipt of proceeds.
A lot of times when you set up a purchase, you know, a PSA agreement, a lot of times you what they'll do is kind of CYAs, they'll agree. This is not uncommon. The lawyers will put in a language that, you know, the seller is thinking of doing a 1031, which technically means, you know, the contract's got to be assigned to a QI. This is just a bunch, in all candor, that's for lawyers to deal with, and it's not that complicated as long as you know what the lawyers are 1031 lawyers. You know, one thing which when I tell people, you got to get lawyers involved who know this stuff. And I use an example, you know, if you've never done this before, don't use your cousin who's a medical malpractice attorney because you owe him a favor or something. You have to have an attorney who does 1031s. You know,
all right, I have a small question. I know Roberto's got like 10, but I want to know about this opportunity zone fund. I'm selling my building and I've decided, oh my God, I can't identify anything, and I've put it into your fund and I've gone for a few years. You're saying that there's an opportunity with the opportunity zone fund for me to get some money out eventually without paying the taxes, or I'm always going to defer the original gain?
No. The original gain, I'm glad you asked that question. The original gain is only deferred until now, December 31, 2026. You do have to pay tax on the original gain. Now this law came into effect 1/1/18. So if you did this on 1/1/18, you would have avoided paying tax until April 15th, 2027. Okay, here's the thing. That gain you do have to pay. But let's suppose, just for discussion purposes, you have $100,000 gain, just by way of illustration. Okay, you pay the tax on that, and you take that gain, and as was said, just the gain, not the principal, the gain, you invest it in a fund. That original $100,000 gain you do have to pay. It's as if it springs up on 12/31/2026. But you hold that investment for 10 years, and that 100,000 is now 50 million, whatever. I'm just saying that entire appreciation escapes federal tax. So some states don't follow that. Now, to get a little in the weeds here, that includes depreciation recapture.
Escapes forever. Escapes.
Yes, it's a true elimination. Now,
and I didn't have to be in an enterprise zone.
No. You do. That's one thing that's very important. In a 1031, you could be anywhere. In an opportunity fund, there are designated geographic zones in each state that the governors of each state designated early in 2018, that you do have to be in one of these designated zones. That's a negative to it. But from a technical tax standpoint, I'm sure everyone on this call sounds like you're familiar with a typical real estate investment. I think there's a rule out there that you have to have negative capital in your real estate LP. At some point you go negative. That all gets recaptured when you sell. Negative capital goes away. Depreciation, there's no depreciation rate cap there. It's a real, when I did a lot of speaking on these, there's some speaking on this when these first came out. And I said, in 2018, the ability to defer the gain until 12/31/26 is nice. I said, that's like a single. If you hit a home run business-wise, remember, this does have to make business sense. But if you this isn't just if you hit a home run in the opportunity fund and the numbers are big enough, that's a walk-off grand slam in the bottom of the seventh, bottom of the ninth, in Game 7 of the World Series.
Got to be a Yankees fan.
If you can do it. Now, the wrinkle here is, and this is something that a lot of people will tell you, this benefit will not make a bad business deal good. If it's a lousy deal, you're not going to get that appreciation. But if it could make potentially a good deal great. And
I got a question. I got a real quick question because I want to make sure I'm right. So if I had a piece of real estate,
right,
and I have a zero basis,
right,
and I'm subject to depreciation recapture, to my understanding, opportunity zone funds do not defer depreciation recapture.
No, there's a step up at the end of the 10th year. It's a true.
Well, no, let's say I sold my property, right?
Right.
Zero basis. Boom.
No. Oh, you're talking about the original gain?
Yeah, my original gain.
No, that doesn't get
that. That's what I'm saying, right? So let's say I sold a $2 million property, right? And I've got zero basis. I've depreciated it for 27 and a half years.
That original gain, you still have the depreciation recapture.
So here it is. Even though I've invested my money in an opportunity zone fund,
right, you're right,
and I know that I've deferred my taxes to 2026, those taxes are capital gains, federal and state.
Right.
But when it comes to depreciation recapture,
that's 25%.
April 15th, you're writing that check, big boy. It don't defer those taxes.
Most people don't know that. On the original gain, you're absolutely correct.
Yes, sir. People don't know that. So we get calls all the time. Hey, I want to do an opportunity zone phone. I said, okay, well, let me tell me how long you've owned the property. What's your basis? Oh, it's zero.
Yeah.
They don't know that come April 15th, they're going to write a check of all that depreciation recaptured. So it doesn't work if you've owned a piece of real estate for a substantial period of time. You need to do an exchange.
Which is one of the reasons why in 2018, 2019, opportunity funds was like, the big new, flavor of the month. As the years have gone on, more and more people, my sense of it, just based on my clients, seems to be there's more of a shift to 1031s.
Yeah.
All right. I want to do some housekeeping, but I'm going to then come back for your final statements on what did we just learn and your crystal ball. But before I do that, I want to thank our sponsor, Grace Farms. You'll find them at gracefarms.org. Talk about a beautiful piece of real estate.
Wow.
That's 80 acres in New Canaan. And they built this beautiful ribbon building of glass and steel. I'm sure they're not depreciating that, right? This steel and glass is going to last forever. But go check out Grace Farms. You'll find them at gracefarms.org. And you can hang out in the tea house with Frank and try some of the Grace Farms teas and coffee and learn about Grace Farms. I want to thank once again our friends at 1031 crowdfunding.com. I want to thank our friends at CBIZ, Alan Blecher. This is where you'll find him. If you had any questions, if you see this podcast and you have any questions, specific tax questions, there you know how to find Alan Blecher at cbiz.com. So what I learned is that the most important thing I learned was this is not for people who need to be in control. This is for people who want to build wealth without having to think about their portfolio and picking properties and flying around the country. This is for people who want a passive investment strategy that has a deferred tax component. What'd you learn, Roberta?
I learned that if I have clients that are in a bind, I got to have them call Ed. That's the deal. How quickly, baby. Ed, how quickly could you execute? For example,
5 days.
So if a client says, look, I have 6, I got to do something in 6 days, I'm screwed. I say, call Ed.
Call me in an hour. We can decide what you want to do. We'll put it on your ID form, turn in your ID form. Your 45 days is done. We can execute from the time you start paperwork, from the time the qualified intermediary wires the money, 5 days you're done, your 1031 exchange is over, start cash flowing next month.
Just saying.
It's a no-brainer. No-brainer.
Assuming the money's in the QI to begin with. It's too late.
It better be in the QI or you're done, right? I'm sorry, got to pay the tax.
But if it is, then that's a great resource.
Thank you, Edward. Thank you, Al.
Hey,
all right.
If you like this show as much as I did, go check it out on Apple Podcasts. Tell your friends, spread the word, give it a nice review, and because we would sure appreciate it. But
that was
thank you guys. This was an awesome show, and I think it's going to live on forever.
Most fun I've had to work in quite some time.
And what's the future? Really, if I come back in 5 years, are you going to say, "Oh, this was a very good idea, but things have changed," or has this thing been fairly constant for the last 10?
Well, it's all based on legislation, right? And so you got to get it through the House and the Senate to change tax law. Well, as long as 1031 exchanges are in place, we'll always be.
I will say one thing: the 1031 has been in the code, I think, since the 20s, or some ridiculously long period of time. Having said that, for what it's worth, there were times every once in a while, like pre-2017, where somebody would propose they're going to eliminate 1031s, blah, blah, blah. And I would always say, you just can't do that. I don't care what your ideology is. It's too disruptive to the real estate industry.
Never going to happen.
In 2017, they did eliminate 1031s for all but real estate. And without getting political, we do know who the president was at that time and what his background was. Now, I don't know exactly what percentage of 1031s were non-real estate prior to that. Real estate was the predominant. I know, Biden's had some proposals where he's thinking of eliminating 1031s. The Internal Revenue Code is a statute. It could come along and be amended. It's a great sort of like red meat thing for certain side of the aisle to rattle their saber and talk about it. I think you would need. If I had a crystal ball, I'd be racing cars with Edward. But
you come race with me, I'll race you. Come on.
Although I'd probably be killing myself in the crash. But put that aside. I think it's unlikely that I think the
1031s are here to stay.
It ain't going nowhere.
Yeah. That's
not until I die anyway. So I'm good.
That's my view is, and this is being recorded, and I hope this ever comes back to bite me, knock wood. But you would need such an overwhelming Democratic majority in both houses to do that, because it would be so disruptive to the real estate industry.
Yes, sir. I agree.
That's my view. All right.
Gentlemen, thank you. I got to go.
Yeah.
No worries, man. Hey, thank you so much, man.
Nice meeting you all. Take care.
All right. Nice meeting you.
Take care now. Great fun.